Welcome, everybody. It's great to be with you today. My name's Helen, and I'm a Senior Manager in the Knowledge and Learning team in AFRS. I'm excited to be here hosting our CapEx webinar. Organisations are increasingly integrating sustainability considerations into their decision-making processes, and this webinar will demonstrate some of the ways in which CapEx processes are changing. Please note we're recording the webinar for others, and it will be made available on the AFRS YouTube channel and website later this month. The 3 learning objectives for this webinar. After completing today's event, you'll be able to describe the business case for embedding sustainability into capital investment appraisal, outline the approach and steps for adapting existing CapEx processes, and translate the experience of learning from others into your work. Please note that throughout the session, we're also going to be running a few poll questions, so please do respond to those. The webinar will last around 1 hour. We're going to have a short intro and then head straight into a 40-minute discussion with our guests to understand the implications for finance teams. There should be some time for Q&A at the end, so please do drop your questions into the chat function and we'll do our best to answer these. Before we start, we thought it would be really interesting to get an idea of how our audience is integrating sustainability into CapEx processes. So we're just starting with a short poll. So if we start with poll number 1, how is your organisation integrating sustainability into capital investment decisions? Not at all. We've undertaken a pilot assessment, undertaken qualitative considerations, we incorporate quantitative criteria, we monetize sustainability impacts, or all of the above. Perfect. Now everybody should be able to see the results. Really interesting. So not everybody is doing all of them, but there are some of the audience doing qualitative and quantitative methodologies or pilot assessments. So that's really interesting to see. Before we move on to a brief introduction, I just want to introduce the guests that are joining us today. We have Giles Ridgley, Head of Technical Accounting at Rolls-Royce, and Rhiannon Dowdall, Finance Director, Business Partnering at Heathrow Airport. A warm welcome to you both. I wanted to set the scene first and just introduce some concepts of how CapEx processes can be updated to incorporate sustainability in a variety of ways. This is very much focused on the how of conducting assessments. When you've already decided what sustainability aspects are important for your organisation. You could look at qualitative criteria, where you might talk about the impact or risk of sustainability in a non-quantified way. So this could look like the project will create jobs. Depending on the project or capital investment, you may decide that quantitative criteria would be useful for decision-making. This can include water use, energy use, and job creation, but it would be expressed in numerical terms. So the project will create 3,000 jobs. Again, dependent on the project or capital investment, you could also monetize the sustainability considerations. In the example we're using relating to job creation, that would mean assigning a monetary value to the 3,000 jobs you've created, which could translate to the amount in dollars that's been generated for the local economy. We really recommend reading the AFRS Essential Guide to CapEx when looking in this area, because there's lots of good examples and further explanation. Corporates are thinking about how to monetize the impact of carbon and other sustainability considerations within investment decisions. And I'm really excited to talk to Rhiannon and Giles about how they're adjusting their own processes. So for the first part of the session today, we'll be speaking with Giles Ridgley. Giles is Head of Technical Accounting at Rolls-Royce Holdings plc, British multinational aerospace and defence company, which delivers complex power and propulsion solutions for safety-critical applications in the air, sea and on land. Giles is part of our 2023-24 Academy cohort and has successfully completed the seminar phase. He's now putting some of those learnings into practice as part of the implementation phase. Welcome, Giles.
Thank you. Welcome, everybody.
Amongst other things, you're looking at embedding carbon pricing into your investment approach. What inspired this for you and for your organisation?
Yeah, it's an interesting one. I think it's probably worth saying on the poll, I'm probably at the undertaking pilot stage, just to put a little bit of context for people. So what inspired me? Well, my day job's about implementing changes in accounting standards across the Rolls-Royce group and working with the business to apply accounting standards to complex situations. So this is the kind of thing I enjoy working on. I've been involved in performing the gap analysis to the TCFD requirements and implementing the step change that Rolls-Royce had around 2020, 2021 in our disclosures. So I found that pretty interesting, and to be honest, it gave a bit of bit of a difference from sort of worrying about IS-37 amendments and that sort of thing. So I really enjoyed the change. It became clear we're moving to a place where we needed to be able to provide external disclosures on how we were considering climate risk in our financial statements. And to be honest, I wanted to take a proactive view to make sure we had a plan to be able to do that as things developed in the future. So decided to get involved there. And that's really come through in the ISSB S2 standard that will require us to disclose the price of each metric ton of greenhouse gases that we use to assess the cost of our emissions. So, important that we're prepped to do that. And it'll also mean that we need to explain how we're applying carbon price in decision making. So feeds directly into this topic of capex. I'm not involved in the day-to-day capex process, so this is quite new to me, and fair to say I think the sessions from A4S have given me a bit of some additional tools and skills and confidence to tackle the project, so that's been really good. From a company perspective, there's quite a few factors, I think, and really some key individuals in sustainability, strategy, governance and finance are really driving the journey. For us, it's really about risk management, which is something in the aerospace industry that's obviously really critical to what we do as a company, and we have a very strong risk culture, so it fits quite neatly into that. The evolution of carbon price and a warming planet is a big unknown, and the company wants to understand what the risk is and whether the cost of carbon could be material to our investment decisions. So we're really supported on doing this kind of project. We also get lots of scrutiny from external users of accounts, interest groups and regulators, because the use of our engines by the airlines does emit lots of scope 3 emissions. So we're one of the sectors that is under scrutiny, and we need to provide relevant, useful information. I'm also conscious in some of the sustainability questionnaires that get filled out by the sustainability team, we have made clear that internal carbon price isn't currently something we use in investment appraisals, but we've indicated that we want to do that and have put a time frame of something like 2 years for us to implement it, and that was a commitment we made a little while ago. So the head of sustainability is sort of delighted that some of her colleagues are interested in supporting her and helping her deliver, so that's been good. Probably lastly, I think as we've been doing this project, we've really felt a pull from some areas of the business to help them evaluate capex schemes from both a financial and an environmental direction. So things like whether we repair or replace parts during an engine overhaul, what are the cost advantages of sourcing work from overseas compared to the carbon cost of transportation and the different energy mix that we see in different places. And we've spoken to people who have tried to raise schemes but not been able to quantify some of the sustainability related benefits, and as a result their schemes haven't been approved, where maybe with a broader mindset they would have been. So yeah, great that something we're doing is welcomed by people in the businesses.
Yeah, definitely. Lots of factors there which really feed into the kind of the reasons behind doing this, and very eloquently expressed. So thank you.
Thank you.
And what progress have you made to date on making changes to your capex investment approach?
So still 10 months away from my project delivery, but so there's lots to do, but we have made a good start, I think. So I think I can explain to everybody what we've achieved so far and also some of the issues we've had. To set the scene, as I've mentioned, as a UK listed corporate, we've had a number of years of collecting, analysing and disclosing data. So this includes scope 1, 2, 3 emissions, scenarios for TCFD strategy disclosures. And we've also been reflecting the risk of the cost of carbon in our long-term aftermarket total care contract. So when we're doing cost to complete accounting, for those who are familiar with that, we basically apply shadow price to add a notional amount that we don't charge to the cost of completing our projects. And that reduces the stage of completion of those projects and changes how much revenue we recognise. So it's something we've got a bit of experience on the mechanics already. So all that's basically given us some principles and data to draw on while we've actually been trying to implement some change on capex. At a high level, our progress has been to develop a method to put a carbon-based shadow price into our investment appraisal pro forma, so that it's being captured as a quantified item. So that's an input field, and it basically takes the emissions change times a carbon price and multiplies it up and includes it in the evaluation, and that impacts the MPV and the IRR of the investment decision. Difficult area on sort of scope 3 and upstream and downstream emissions. Our upstream emissions in our supply chain, we do take those into account, but we do have to make assumptions about how our suppliers are decarbonising. But we do, you know, we have introduced some sort of thought process on how the businesses would do that. As I mentioned earlier, the sort of the use of our assets, our scope 3 category 11 emissions is our biggest emission number. And we have basically given some guidance to the business how they can think about the impact of scope 3 emissions on sales volume and pricing assumptions. So applying a carbon price to our scope 3 emissions won't hit us as a pound cost, or we certainly don't expect it to. But you know, if those emissions are being taxed, for example, on the airlines, then you know that may impact their ability to pay us for the engines, for example. We've not really had the opportunity yet to apply the principles to something like a big new engine development program. That may come in the future. When we've been developing this process, we've basically focused on 4 to 5 real capital schemes that had already been approved, but we've retrospectively gone back and looked at those and sort of said, okay, if we'd have taken carbon into account based on what the team know, what would the impact have been? So one of the projects we looked at was a factory refresh and fit out, and you know whether any of those decisions would be impacted by this kind of thinking. We've basically got to the stage where the head of investments has agreed that we run a formal 6-month pilot now on the schemes that will go to our top level investment committee in the first half of 2024. So we're set up, we've sort of tested it out, but we're now doing a more formal pilot. That activity has basically come from about 6 months of weekly meetings. So just having that in the diary has been helpful. Some of the issues we've had, I think data availability in some of those historic cases we've tried to apply it to, things about energy use and carbon emissions have been quite difficult data to apply to the specific situation. So we've got the data, we're used to reporting it, but when you actually come to cut it to apply it to a specific scenario, that data is not always available or always available in the right form. So we've had to work through that. As we've started to ask the questions, I think just people's ability to know where to look and who to speak to has grown. I think the other issue we've had is that only one of those 5 projects we've looked at had a significant carbon impact. And even then, in relation to some of the other flows, it maybe wasn't particularly material. We think that's due to the relatively short payback of the schemes we were looking at and the fact that carbon prices will increase in the future. So we're working through that and just trying to get our logic right to apply going forward. Things we still need to do, need to complete the pilot, get through a go, no go gate, prepare instructions and training material, which we've made a start on, and then do a launch and decide whether that is going to focus on the biggest schemes that go to our top level committee, or whether it's something that would be rolled out to the lower delegated authority levels as well. Fair to say from the A4S maturity maps, we've started off as very much a beginner with limited sustainability recognition, and then through sort of focusing on quantified analysis and influencing decisions, we're sort of edging up towards the intermediate. But that was a tool that was useful internally for just talking around what we were doing.
Great, thank you. And yeah, if anybody is interested in the A4S maturity map, it's on our website. We will be sharing the link to that after the session. It's a really interesting point that you mentioned about the 6 monthly weekly meetings. I think that really just demonstrates the kind of action that's needed to try and kind of catalyze changes in the organization.
Yeah.
And talking about or thinking about that mindset shift, how else have you kind of catalyzed that within the organization? So you've had the kind of weekly meetings, but have you done anything else to kind of get people on board with the process?
Yeah, I think the catalysing sounds a bit of a grand claim. There's still lots to do, but I think there's probably 7 things that I had to think about my colleagues about what we've done. I think the first one is that scenario analysis and long-term contract accounting that we've done that's given us familiarity with the concepts. So that's really helped. There's been a number of sessions across our organisation and in the finance teams to just get the knowledge of sustainability increasing all the time. And I delivered an online climate training session in our learning week called 15 Things You Need to Know About 1.5 degrees C, which covered this kind of topic and just kind of laid the seeds that change was coming. So that was probably the first one. I think our work on TCFDs taught us there isn't a right way to do things. Industry and auditors and other people are all learning together. So we've been keen to hear what other people are doing. And I think by doing that, I think we've developed our confidence in how to tackle. So that was really important to enable us to make some change. And then I think identifying good examples from peers, and really to demonstrate that this is something that people actually are doing, rather than just a conceptual argument, because there's internal stakeholders who've really taken a bit of convincing that others in our industry are actually doing this. So that was really important. And I think the A4S written examples and the discussions with the other members of the cohort has been really useful on that as well. And sort of shared that information with the project team. When we sort of formulated our ideas of where we wanted to go, we ran that past our external Big Four advisor, who we bounce our climate related reporting ideas off. And I think that gave us some good tips, but also gave some credibility to the proposals we were making internally, because we've had that discussion and it made sort of validated that we've done our homework, I think the other thing that's happened over the last 18 months is our corporate climate work programs become much more structured. I think before it was maybe being driven by sort of a small number of interested individuals who really pushed us forward and did the early learning and development. But over the last 18 months, we've got a specific work breakdown structure with teams, with accountabilities, and probably importantly, access to steering groups. So that meant that as we were developing this, we could take it to the steering group and get senior level buy-in that this is something we were looking at doing, where we were, and getting that support to push it forward. A couple more, I think, passionate sort of believers who can portray the need and the benefits of change was key. I sort of refer back to the A4S session on telling persuasive stories, which I must admit pushed me out my comfort zone. I'm very much a fact-based argument person, but I think the guidance we got there about getting an emotional connection and telling a passionate story was really interesting. And I suddenly found myself having a big debate with the head of the capex process on why we should do qualitative assessments of waste recycling and energy consumption and that as well. Now, I think ultimately we probably weren't ready for that at this time, but it was an interesting debate to use those skills and push for that kind of change. And probably on that note, I think having to fight to keep change on the agenda. As I've mentioned, some of those early schemes we've looked at didn't have a material change, but I think we've sort of badged that as we've not seen a material impact yet. And I think from doing the work, I think it's enabled from a risk management perspective to show that it's actually a good thing. We've thought about it and we've demonstrated that on those schemes it wasn't material, but there's other areas where it might be, and as a result we need to push it forward. I guess the worry on that is, I think, one of the examples in the essential guide that sort of had one of the companies that had implemented this. It was all going well, and then it had been enthusiastically adopted, but then senior management changed, and there was fewer questions, and sort of monetarized carbon impacts got dropped. So we're mindful of that and need to keep sort of influencing to make sure we can push this through as we go through the pilot.
Yeah, great. I think there was a really interesting comment as well around the fact persuading people that other people are doing it. And quite, I think historically a lot of these processes have been kind of in the back end and not really out there. But now with so much more transparency and communication around what corporates are doing, it does seem that there's more kind of clarity over what people are doing and how they're doing it, and lots more knowledge sharing. So very interesting kind of world to be in at the moment.
Yeah, definitely.
For the practical approaches, what did you find was really helpful when you were kicking off the process and brainstorming ideas?
I think our approach kind of evolved over time. So I think rather than doing a sort of big upfront sort of brainstorm, I think we were bringing a number of individuals up to speed and bringing extra bits of information in. So I think as we did that, I think just the thinking developed. And I think we've already mentioned that weekly cadence of meetings to make sure that it did keep getting touched on was really important. I've seen comments to say there's no one size fits all solution, and the answer depends on the organisation circumstances. That's very, very true for us. And I think it became clear that what we really needed to do was slot a recognition of climate risk and carbon pricing into our existing process, rather than go and do anything which felt too removed. I think getting some different people together has helped. I've been lucky that the head of strategy and the head of sustainability were involved in all the other TCFD work we've done, and they've been on the working group we've put together. So we've got all that rich knowledge from what we've done before coming in. But we've also, in Rolls-Royce, we have something called a gig, which is where someone can go and do a small project in a different area of the business and basically learn some skills and bring their skills to the project. So we've had sort of a young keen engineers join the team, and he's actually, brought some new ideas to the table, challenged some of the things that we've always done. And for example, the head of our capex process had only just improved the process, so wasn't particularly looking for another change to come in and amend what he'd just done. But just bringing some different people in brought that energy to push it through, and also meant that we probably had a mix of levels on the team. So it wasn't just everyone discussing the concepts and thinking what the action should be. We had a few people in the team who could really pick it up and run with it and sort of get the work done at the detailed level. So that was really good. I think probably the other thing we've just had to think about is compliance and enforcement as well as part of this, and think through that side, and just make it clear to people that this is going to be the process, and it's not optional, and they need to pick it up, learn from it, and incorporate it into what they're doing.
Great, thank you. I love the idea of those gig days, kind of the sharing the knowledge and changing up the energy and getting different views on the project and how it could be implemented. Sounds like a really creative way to make progress. So thank you for sharing that.
It's great for people's development when they work as well.
Yeah. Okay, thank you so much, Giles. It was really interesting to chat to you. Before we move to Rhiannon, we're just going to run a few polls just to consider some of the discussion that you've heard to date. So for the audience, if we run our second poll, company is looking at the whole life carbon emissions of a project, applying a carbon price and adjusting the cash flows by the carbon emitted or saved from the project. What methodologies does this incorporate? And you can select multiple answers. Is it business as usual investment analysis, qualitative assessment, quantitative assessment, or monetization? Hopefully that was enough time to answer. So if we finish the poll there and share the results. So this was a trick question, but lots of you got right in the right areas. So the answer is both quantitative and monetization. So the organisation would need to understand the carbon emissions of the project across its lifespan in order to apply a carbon price. So the correct answer is quantitative and monetization. So poll number 3. What type of sustainability considerations could be incorporated within capex investment decisions? So if we move on to the next poll. So what type of sustainability considerations can be incorporated into capex investment decisions? Water use, energy use, job creation, carbon emissions, carbon pricing, or all of the above? So everybody's answered, and I can see that everybody does have the correct answer. So the purpose of amending your decision-making process is to support your organization in achieving its strategic ambitions. The way that you amend your capex investment process will therefore depend on what is significant for your organization and the decision being made. Any of the considerations here could therefore be incorporated within your approach. Also, just a reminder before we move on to the discussion with Rhiannon, we do have a Q&A, so please do drop your questions into the chat, or if you've thought of any already, then drop them there and we'll try to get to them in a moment. So we're now moving on to a discussion with Rhiannon Dowdall from Heathrow Airport. Rhiannon is Finance Director, Business Partnering at Heathrow. She leads the team partnering the Operations, Commercial and Solutions Directorates to financially inform their decision-making. Heathrow Airport is the UK's biggest airport, serving hundreds of destinations across the globe. Welcome, Rhiannon.
Hello, good afternoon.
So, your perspective is more of one of an organisation that's been embedding carbon into capex processes in particular for a number of years now. It'd be really interesting to hear about your progress and why you're focusing on carbon as a priority.
Yeah, absolutely. And Giles, just to reassure you, I think you've done an incredible job in such a short period of time, I have to say. So I wouldn't classify you as beginner as you seem to think you are. But so yeah, for Heathrow, we have a sustainability strategy called Heathrow 2.0, and it has 3 pillars. The first is net zero aviation, the second is great place to live, and the third is great place to work. We launched that pre-COVID and recently refreshed it. And our intent is that we embed all of those strategic and target considerations into our capital investments and decisions. But we have focused on carbon mainly because it's the largest existential threat to our business. If we don't decarbonize aviation, then there's a huge risk of passengers not willing to fly, increased regulation, or governments reducing flights. And I imagine Giles in Rolls-Royce has a very similar threat to the long-term sustainability of the organisation. So for that reason, we focused on carbon, but also because it is relatively more easily understood and quantitatively measured, and there is quite a lot out there in terms of monetization. So it felt like there was enough learning around general industry and approaches that meant that we could test and learn using carbon to start with, and then as we get more mature in our thinking and capability and embedding that process and evaluation into our investment decisions, we'll start to roll it out across more of our sustainability considerations.
Yeah, really interesting. I think a lot of corporates kind of are moving the same way, with some of the sustainability impacts being a little bit more challenging to monetize when the kind of data and information might not be as readily available. And how are you going about embedding carbon into your capex investment decisions?
So we have a few approaches. So we have a capital investment portfolio which spans across 6 different programs, and each of those programs have different outcomes. One of those programs is our carbon and sustainability investment program, and that program is really focused on making sure that we are spending the right amount of money to eliminate carbon from our business. And we focus, when we talk about carbon, our carbon impact, we actually talk across all 3 scopes, mainly because by far the largest scope for us is scope 3, although it isn't entirely in our control. As I said, it is an incredible existential threat to us. And so the first part of the work that we're doing is to work with that carbon and sustainability program to make sure that we are prioritizing investments in initiatives and solutions that drive carbon out of our business and out of the industry. So, for example, we are looking at changing the way that we support airlines in refreshing the cabin air, so providing that using electricity so they don't run their engines and use aviation fuel. And what we are doing with that programme is doing what's called a marginal abatement cost curve analysis for all of the initiatives that we think would eliminate carbon in and around the airport. And so what that does is it essentially evaluates the whole carbon impact of the solution. So whether that's the embedded carbon to deliver it, and then the carbons that it reduces, the carbon emissions it reduces, or the potential benefits in the longer run. And we then apply a carbon price to it, and we make sure that those in the left-hand side of the curve that Helen has very kindly shared here, essentially you see for each of your initiatives, it's those that are going to be your quickest wins will be on the left, where you've got a lowest cost per carbon and a highest benefit, and then towards the top end are those emissions that are hardest to get to, and that enables that particular programme to prioritise which order that they invest in these solutions. And so that has been a really helpful exercise, and it is one that is well recognised both by industry and by regulators. And so in terms of talking to the Civil Aviation Authority, we can evidence that in fact our cost curve outperforms the government set prices, and that makes sure that we are driving value for money in what we're doing. The second way in which we are driving out carbon through our capital investments is across the entire portfolio, challenging each of the 6 capital programmes to cap the amount of embodied carbon that they emit as a result of their work. And we've done that by implementing a carbon intensity factor. This is work that we have done with a body called the Carbon Trust. And what it does is it helps us to identify the types of capital investment that we are making. So whether that be civils works or technology, and it essentially applies a ratio of carbon emissions to that type of spend. And therefore you can take one times the other, gives you your maximum cap. And then we challenge every single one of our programs to monitor and drive out carbon from every part of their program. And that leads me to the third thing that we're doing is the programs can only do that by monitoring each and every single one of our projects. And so we have using carbon shadow pricing, supporting the business on the investments that we think are the most materially impactful. We are applying a carbon shadow price to include within our investment appraisal. We use IRR here at Heathrow. And so we are helping the business to understand and hopefully reduce costs by or carbon emissions by enabling them to see that if they don't drive out costs, in fact, it's going to cost them more in the longer run. And so in theory, they can invest more money in reducing carbon and overall outperform the IRR that they would have otherwise done.
Yeah, it's a fascinating range of activities that you're putting into place in the organisation. I think I have another question around kind of the strong focus on emissions reductions and how you're amending your capex decision-making processes. You mentioned IRR, but is there kind of anything other that you're doing in the organisation?
So I think most organisations, we are fairly capital constrained. Money is one of the constraints that we have to manage within, and so absolutely being able to prioritise and reevaluate IRR continuously through the life cycle of the programme is really, really important, and of course the life cycle of the entire portfolio. And I do think that monetization of carbon emissions makes it very easily translatable to the whole business and across our supply chain. And so what that means is we have a greater focus at what we call our gateway to options decision in our capital investment decision making. So what we are implementing into our gateway process is that true evaluation of two options, that one might be a standard way of delivering perhaps runway resurfacing or building a new piece of infrastructure with standard materials that might be cheaper versus potentially deploying greener concrete or looking at different ways of building that overall will reduce your carbon emissions. And because you can monetize it, then it is much more likely that you drive behaviours automatically to choosing greener, lower emitting solutions.
Yeah, fascinating. And you've talked a lot about kind of the supply chain, so working with upstream and downstream. But how are you engaging with your value chain more widely to bring down their own emissions?
So we have a couple of mechanisms, again, that we're working with our supply chain. So one is we have implemented what's called a balanced scorecard. And so part of our supply chain reporting into our procurement team is really evaluating all of their impacts on not just carbon, but every part of the sustainability metrics that we measure. And so that enables us to understand essentially the overhead costs of our supply chain for the work that they do by being on site, how they get to site, and support us in running our capital investment projects. And then we have the actual embodied carbon measurement, and this is probably one of the most problematic areas and challenges that I'm sure everyone is grappling with, is that because this is so new, there is a wealth of different measuring techniques out there, and standardizing those and translating them into one set of data that we can recognize and use to measure is proving an interesting challenge, and not one that we've totally surmounted yet. And of course, carbon is in itself quite difficult to physically measure. A lot of measurement of it relies on a huge amount of calculations and assumptions to evaluate it. And so that is the part in which we're probably spending more and more of our time at the moment to try to identify exactly which measuring tools and techniques we want to use, and then embedding that consistently across our supply chain.
Yeah, great, thank you. And thinking about some of those challenges around data, do you have any kind of key learnings or across the whole process? Have you come across any key challenges or key learnings that you'd like to kind of share with the audience?
I would absolutely echo a lot of what Giles has said. I absolutely believe that this requires personal energy and effort, and consistent communication as to why this is so important, and sharing that others are doing this. I think from a finance perspective as well, one of the really great levers is the fact that our investors really care about this, and it is going to become much more enshrined in accounting standards going forwards. And so this isn't just a nice to do, this is a need to do if we want to be a thriving, sustainable, long-term business that's attractive to investors. That is very helpful. I think as well, I reflect from Giles's comments, we started with a group of very passionate amateurs, I've called us, throughout, but what is starting to actually really now help us build up the momentum and speed of implementation consistently is actually embedding this requirement in everybody's day job, and it is part of existing processes. So we're not trying to change our gateway life cycle. It is part of the gateway life cycle of a capital investment project. We're not trying to change our financial processes. We are investing, appraising everything, including carbon. And I would say, most of all, don't let perfection get in the way of progress. Be prepared to fail, test and learn. You know, I think Giles has mentioned he's using shadow price. Of course we are as well, because we don't yet properly understand exactly what reducing carbon from our business totally will cost us as a benchmark that we're prepared to use consistently, but just trying it and seeing what the impact is on change of behaviours is really important, and continuing to test and learn.
Yeah, some really valuable comments then. Thank you so much for your comments. We're now going to be moving on to the section of the seminar where we ask audience members to put forward their questions. So if you're listening, please do, and you have any burning questions, please do put some questions into the Q&A and we'll do our best to answer them. But firstly, one for Giles. Rhiannon, you mentioned kind of carbon pricing and the difficulty of using a carbon price, but Giles, perhaps both of you, what's kind of influence did the carbon price that you've selected?
Shall I go first? Yeah, I think it's that we started off with that point that there's no right answer. I think so. We've looked for what the most logical thing for us to do is, and for that, I think it's to align with the assumptions we've used in our TCFD scenario analysis. So we use some International Energy Agency net zero scenarios that basically the carbon price grows from about $46 a tonne in 22 to about $250 per tonne in 2050, and we assume that grows on a linear, just a linear approach. That, I suppose, it's slightly more complicated because we've got a different rate in each year, but I think it's a better reflection of the cost that we're going to see. We also have a slight refinement that we've got different rates for different markets that we would sort of maybe look at in our supply chains. So we've got an advanced and a developing economy rate because the data set we use has got quite a difference depending on where the emissions are going to be. From discussion with some of our peers, we're seeing a variety of different answers. So, one's using a single flat rate, for example. One we know is charging a premium to, high carbon projects to incentivize sort of sustainable investment. We haven't. Our target rates and our carbon prices applied consistently to everything. I guess the other thing we've done on the sort of near-term rate is we've been through and checked that against the actual costs we're seeing through different sort of carbon taxes and similar, and that was a fun activity. But we've basically demonstrated that it was in the right ballpark, so that was pretty useful.
Yeah, it sounds like an interesting exercise and quite valuable information. Rhiannon, how did you kind of think about your carbon price that you selected?
Yeah, I think very similarly, we had a look at the ETS markets. We had a look at the price that we are investing per carbon tonne with our current investment profile. We evaluated the government price, and it is a very high price. And so we started with that one on the basis that it felt like it was a very recognizable number, and that it had relevance and good assumptions behind it that would be recognizable and supportable. And in fact, it has been used to evaluate our investment portfolio by others externally in the past. So if people are already using it, then it makes absolute sense that we're ahead of that curve and understanding how they are evaluating us. And then we also had a look at what other companies were doing, and the range was quite significant, all the way from kind of $1 to thousands of pounds per carbon tonne, and it felt quite honestly overwhelming, and so it felt that it was the simplest and most accessible price to use the government number at this particular point. But as I said, we're testing and learning and trying different ways of it, of trying to see how we influence behaviours by the use of that price.
Yeah, really interesting that point on the kind of internal selection versus what external stakeholders might be looking at in terms of carbon pricing. And that is an interesting area because it might be shifting over the next as people become more familiar with carbon. Interesting consideration. One for Giles again. So we've talked about kind of data challenges, but there's a lot of uncertainty, especially for accountants who are kind of used for fixed data on how to fill out areas where there isn't the information. So how have you kind of gone about looking at data gaps and kind of using assumptions and proxies to support your work?
Yeah, I think as Rhiannon said, I suppose for our normal emissions disclosures, we're having to make the same estimates, in places. So that I suppose we do a lot of that in finance anyway. I think from the actual capex work we've done to date, it's really been trying to fit the data we've got to the specific scenario, and that really needs the expertise of the people who've been involved in the process before. So some estimates will be needed, but if you're investing in a particular facility, but maybe at a supply chain manufacturing unit level, that's how you normally look at your data. There's enough information there to make the decision, but you've kind of got to go and find it and interpret it and work out how to use it. And I think that's the bit that, as we were developing the principles, took some time. And I think ultimately that will be the key through our pilot about how much time is it taking and against is the impact material when all that work's been done. And one of the things that we have introduced in our sort of draft plan is effectively a filter or a triage where we say, actually, is there a level where you just say this isn't ever going to be significant enough, so we're not going to go and collect all the data and focus on the ones where there's a real risk. So yeah, it's hard, and how it's going to look in our finished process when our business is quite varied under the skin is going to be an interesting one.
Yeah, really interesting. And on that point, I suppose for Rhiannon, you've been through a few years of kind of having these processes in place, but are there areas where you want to refine and kind of alter the process to make it more effective, or are you kind of happy with the outcomes?
Goodness no, we're still testing and learning for sure. So the areas that we're really focused on are making sure that our engineering standards help drive the right behaviours in any case. So that's something that we're still working on. And then even the collection of data is probably really still very manual. We've got a lot of very complicated spreadsheets that we are working on trying to capture more automatically and digitally and make and have one source of truth. And we are, as I said, trying to embed it into the gateway process so that it becomes the way we do things. I think measurement still requires a lot of standardization and translation. But as Giles said, we're just prioritizing the ones that have the most material impact and accepting that at the moment that's quite a manual process. The next phase of work for us after that, and we get happier with the outcome, will be the wider sustainability metrics. So as I said, our other pillars in our strategy are on great place to live and great place to work. So we're having a look from the live perspective on our impacts on the local communities and the wider community, especially on our noise emissions as an airport. And then we also, from a great place to work perspective, of course, are looking at all of the ED&I metrics and making sure that we are trying to quantify and monetize that value. And in fact, we have a project going called Total Value, which will try to do just that. Not only value the investment that we're making and the benefits that those investments are having, but properly understanding the impacts and on all of our operations on our communities and our colleagues.
Yeah, that sounds like a really interesting kind of area of exploration and demonstrate kind of how capex might shift over time. after the kind of looking at carbon and then looking at the wider kind of societal impacts. So thank you so much for your contributions today. We're going to move on just to the close, and I'm going to share a few links to our various guides and resources. So if you're interested in finding out more around the topic, we have a range of resources on the website, including the APRS Essential Guide to CapEx, which we've spoken about a few times, but it's a really helpful guide which has some of these principles and a bit more information and some great case studies. We've also got top tips for organizations starting out and a maturity map, which Giles referenced earlier, which can help you kind of see where you might be on a maturity map. As you may know, the 2024-25 APRS Academy is now open and is taking applications. The Academy is a fantastic learning program which takes finance professionals through a 6-month live, online and interactive course, followed by a 12-month implementation program, where the learnings of the Academy are put into practice. Applications are open until the 29th of March, and we're sharing the links to the Academy page in the chat so you can read more about it or share the links if you're interested. And now just 2 final polls before we close. Do you think that embedding carbon into capex investment appraisal would change the outcome of your decision-making process? So if we have poll 4, yes, no, it would depend on the boundaries of the assessment, or it would depend on the carbon price used. And if we close that and then share the results. Yep, interesting. Ultimately, it would depend on the boundaries of the assessment and the carbon price used. We kind of heard that from the speakers, and it'd be interesting if you're piloting it to also find similar results. And then for the final poll, which we'll leave running as we close, based on your experience today, how likely are you to recommend APRS Sustainability in Action webinar to a colleague or peer? 1 being not at all, and 10 being highly likely. We'll leave that one running and close it just before we end. But once again, thank you so much for joining the discussion, and thank you to our guests, Rhiannon and Giles. It was a really interesting webinar, and I'm really looking forward to seeing you at the next session. So please do close and share the results, and then we'll close the webinar.